and you have the Fed. And the way money is created is the U.S. Treasury issues a bond or debt. And generally what happens is banks and investors come in and they buy this debt. And money just flows in, and it flows into the U.S. The U.S. economy here. That's normally the way it is. But what Jerry is saying, what is significant, is these guys are no longer showing up. They're not buying our debt. They don't want our debt. They don't want to be paid back with dollars that are worth less and less and less and less. So when they say monetize, the Fed then steps in and buys our bonds, our treasury bills, and all this. So everybody's out of this today. That is a significant part of this. PIMCO, which is, I don't know the name of it, but they're supposedly the smartest guys in the room.
Right.
They have been selling this stuff.
They don't have any. They've sold all of it.
They've sold it. They don't want U.S. debt. That means they don't want the U.S. dollar. That's really what it means.
It's a buyer's strike is basically what it is.
Yeah, it's going down. And I've been saying this to my brother and my sister. And I'm like Chicken Little, you know, oh, the sky is falling, the sky is falling. And as Jerry said when he first came in the room, when we just started talking, he says, it's up to us to just tell people what we see. Well, we could be wrong. We could be wrong. But when that stops, when these guys stop, and our own government, Fed, which is not government, by the way, steps in to buy our debt, that's what Jerry means by monetize. That we say our debt is now
we turn our debt into money, because basically when they do buy that debt, it doesn't go away. It goes into the banking system as a reserve. This is it's not like just cranking up the printing presses and printing a lot of money out of thin air, but essentially that's what it is, because money is created out of a debt instrument.
Right. And that's what they're kind of calling today. We're right at QE2.
QE2 and QE3 is just right around the corner.
Yeah. QE2 means quantitative easing, or print money, or we're buying our own debt. So the Fed is just writing checks that they don't have any reserves. It's the federal, it's not federal, has no reserves, it's not a bank.
Right.
It just writes checks to buy our debt. So that's our money coming straight this way in many ways here, because these guys stopped showing up.
Plus, that's the seeds of hyperinflation, which is what we're in for.
Yeah. And plus, with the tragedy in Japan, I mean, that's really a tragedy.
They were our number 2 buyer.
Yeah, the Japanese aren't coming here. The Chinese don't like us. They're our number 1 buyer, and Europe's in trouble.
And we'll have the worst of both worlds, because Japan itself is 12% of the entire world's economy. And if they shut down because of their lack of ability, and they're doing their own quantitative easing to keep their economy going and to try and rebuild, injecting billions of new money into the system. And in spite of that, I saw the yen just hit a new high against the dollar at 80 to 1. It was always 115 or 120 yen. It was this cheap currency. Yeah.
I'm old enough to remember yen at 360 to 1. That means $1 took 360 yen. And today, what is it?
80 to 1. I mean, it's which just tells you how bad the dollar is.
I mean, the dollar's going, the yen's
even
going
the Mexican peso is going up against the dollar. The peso was, I remember when it was 12 to 1. Now it's back to 10. That always goes the other way. So when the Mexicans don't want your money, that's pretty serious. So it's like somebody has to ring the bell. And John Williams, in that article, it's 66 pages. It's very long, but I couldn't put it down. And I thought, my gosh, I've been reading this, but not from this particular source. Now we have a war involved in our third war. Now they're going to be involved in. That's going to cost a lot of money.
You mean in
Libya?
Libya.
Yeah.
But that's coalition forces.
There's a lot of things all coming together at one time.
Right.
And how's the economy going to recover? The best projections I see are at 2% GDP. 2%. That isn't enough to do anything.
No.
So we have the worst of both worlds. We have hyperinflation and we have no growth. So we have basically stagflation.
And the jobs aren't coming back.
No, they're not. No.
And then in February in the United States, the new home sales dropped by 9.6%. That means there's 10% less people buying houses in February of 2011. So I hate to be pessimistic or sound like Chicken Little, but you should have bought silver under 20.
Yeah, well, you have to be realistic now, and you cannot depend on the news media for help, and you can't really depend on the government for reliable information. They massage the figures for political reasons, and so basically, ladies and gentlemen, you are on your own. You are your own central banker, your own economic advisor, and Robert and I are here to help. It's not like we need a lot more money because we're both comfortable enough. It's just that people need to know.
I just bought more gold from Jerry because he didn't have any more silver to sell me. But it's really tough, because, talking to my wife, people are so used to holding cash, and they feel comfortable with cash, but cash is trash. I mean, that's what this thing shows here. That if you're holding on to dollars in your savings account getting 0% interest, meanwhile gold and silver are going up, if gold and silver are going up, that means the purchasing power of your dollar is going down. That's why the ratio between the dollar-yen ratio is so important. The dollar is dropping like a rock. Now I know some people will say, well, it'll bounce and come back up again. But I really don't see how. And I agree with Jerry, the stock market is, getting back up, hoping to get to 14,000.
Well, see, that's where this money is going.
Yeah, into the stock market.
That's right. That's exactly where it's going. I mean, if you're not interested in gold, or you're anti-gold, well, then what else would you do with new money? I mean, if you put it in the bond market, that's a guaranteed loss because interest rates at this point only have one direction to go, and that would be up. So as the rates go up, the value of your bonds are going to drop. So that's really not an option. And of course, real estate, we all know about that. I mean, unless it's good real estate that produces an income that's better than what's going to cost you to finance it. And that we may not be through going down in real estate prices as well. So,
well, just to let you know, the three ways I combat what this is right now is I hold my excess cash in gold and silver, either ETFs and things like that, and hard metals. I also have a business that does very well in bad times. But the third thing is I use debt. So tomorrow I'm flying to San Antonio with Kenny McElroy, and we're looking at another $40 million project because the government is going to give us the money to buy it. And we're going to pay it back with cheaper dollars. So if you really don't know anything, gold and silver right now is the safest, surest thing given this here, the printing of money. But you've got to do something. I mean,
well, we haven't mentioned. You mentioned debt as a useful tool, and given that we think this is going a lot higher, it'd be probably seductive to think that maybe you could use debt to increase the profitability of your gold and silver. That's really not what we're talking about. No. I mean, trading the market, I have found out in the past, is very difficult because you can buy gold here and get 10-to-1 leverage with certain kinds of products, whether it be futures or options. And you have a very good chance of a 10% correction in this market from 1450 to 1300. I mean, it's possible. I'm predicting it, but which would wipe out your equity. And so if you didn't have deeper pockets to make margin calls and be able to sleep nights while this is going on, if you can't do that, then you have no business entertaining using debt here.
You have to learn how to use what's called technical trading, or TA, technical analysis, to play this.
Yeah, for the average person, it
doesn't have those skills.
It doesn't work. You just buy it, put it away, and sit it on as your reserves.
My message here is the average person is so used to cash. They feel so comfortable with cash. And it's possibly the worst thing they could hold on to. Right now, what Jerry's saying is you should go to Costco or call it Walmart,
whatever,
and buy staples, food that you're going to use, because 1 year from now that food is going to be higher.
Right. It'd be the same as if you're preparing for an earthquake, because essentially what we're looking at is a financial calamity of the order of an earthquake.
Right.
And so you should get prepared. If I could just mention one story. We talked about the argument of whether to buy here or there. This happens to me about once a week. I had a couple come in from out of town, and he had called me on the phone. We talked at length, and he had $400,000 in his Schwab account, which he wanted to put all into gold, and I said, yes, we could do that and everything. So they walk in, and the couple are arguing in the hallway outside my office door, and they finally come in, and I get to meet them, and he said he had a hard time talking to his wife into even coming in. So they're sitting there in front of me, and we're talking about how to do this, and she's very negative. I could tell she's not on board. and they're still arguing. And I went out to get some gold to show them what they were getting, first-time buyers. And finally, he said, "Well, I think we're going to settle here. We're only going to get 100,000." She just could